ladies and gentlemen. Welcome back. From the big smiles on your faces, I trust everyone had a great break. For those of you that are just getting your cups of coffee, I invite you to join us back in the ballroom and kindly take your seats, please. I know my speakers are all waiting very patiently by the side of the stage, all ready to take the stage and share the macroeconomic trends with you. But before they do, I'd like to invite everyone to take your seats, please. We are about to start. We're also about to close the doors. Thank you very much. Fantastic. Just going to give everyone a couple more minutes to settle in. I think we're all excited to see each other at the start of the year. And lots to discuss, lots to, well, grow your network, as you heard a lot of that earlier too. If I could invite everyone to kindly take your seats, please. We will be starting. Okay, fantastic. A few more of us have done so. Wonderful. All right, ladies and gentlemen, we're going to be continuing our morning with the next segment. I believe you are all set and ready to go. Now, to, of course, make better decisions and capture opportunities, businesses need to stay informed with the macroeconomic outlook and the trends. And for 2025, our macroeconomic outlook will be presented by the UOB Global Economics and Markets Research Team. Ladies and gentlemen, before they do, a final reminder to please take your seats, please, as the gentlemen are about to take their stage. With a warm round of applause, please join me in welcoming all three gentlemen to the stage. Mr. Suan Teck Kin, Head of Research. A warm round of applause, ladies and gentlemen. Mr. Peter Chia, Senior FX Strategist, and Mr. Victor Yong, Interest Rate Strategist. Gentlemen, stage is all yours. Take it away.
Hey, good morning to everyone. See everyone again. Good morning, Mr. Wee and Brad and Hong Kong. Thank you so much, and Popco as well. Yeah. Thank you so much for this morning's sharing session. It was very insightful with the panel, Kun Hao, and also with Prof. Chan. There are a few keywords that I still remember. I think please summarize what I'm going to say. Okay, that's very important. One is collateral damage from the tariffs. We all have to be aware of that. Later on these trade tariffs portion, although Singapore may not be affected directly, I think it's very important our businesses to be aware that we could face the collateral damage. Even though we are in Singapore, with a free trade agreement, chances of getting hit will not be that high. But what happens to your trade partners, your suppliers, your customers? They might get hit. So think about the taxation benefits, right? Taxation benefits. The other one, of course, is hedging. Very important. Continue to take the opportunity to hedge. So for businesses as well, right? So take advantage of everybody in the room here, our colleagues from the bank. Everybody is here, and talk to them. Right? How can we provide solutions for you for your problems? And also, of course, the last one is very instructive. No need to say much. Is gold. Right, gold is still very much in focus for some of you, so it's very important we think about this asset class as well, right? In addition to other things. So thank you so much for paying attention. Today I'll be here with my teammates, Peter and Victor, and together, of course, Kun Hao as well in the team. My name is Teck Kin. I will share with you in the next 10 minutes some of the key things, 3 things to look out for over the coming year. And the next item here, trade tariffs, Prof. Koh has talked about this morning, and the panel just now, the fireside chat, also talked about tariffs. Well, next week, in less than 6 days' time, in about 6 days' time, this may not be valid anymore. So let's see. But this is our view, our collective view within the team, UOB research team. Look at how we look at the tariffs. So our base case, our base scenario, is that there will be tariff increases. Like what Prof. Koh said this morning, there will be tariff increases. It's a matter of how much. So in our base case, we are looking at the middle, 55% of some form of tariff increases over a short period of time, over a period of time, right? So that is a more moderate form, right? Some increases, for example, here 25% on China and 10% on the rest of the world. So this is our estimate or our guess, because by 20th of January, we'll find out more, there will be more clarity. So if in the case of a more moderate base case, there will be some implications. Of course, in the extreme case, the pessimistic case, what President Trump or President-elect Trump talked about 60% on China, there will be more severe damages, right? More severe damages, not just to China, but to the rest of the world as well. We'll see what kind of impact. Let's take a look at the next one. What are in the base case, at the bottom here, our forecast for global growth and for China and for US will be in similar to what we saw last year. That means it's a kind of a steady environment. But in the case of extreme, these are pessimistic case of 45% probability, not small, 45% probability, the global growth will drop to about 2.5%. This is a near recessionary sort of environment. In the US as well, will drop to about 1%, 1.3%, and China definitely in 3.5% range. That will be what they saw, what China saw during the pandemic. Is near recessionary for China at around 3.5%. So when we talk about collateral damage, how does it work? So you think about Singapore being very open, right? So if there is a severe case of a tariff being imposed, trade activities, your businesses will slow down, right? Orders will slow down. So our estimate, our team's estimate is that every 1% drop in global trade, 1% drop in global trade will impact Singapore's GDP growth by about 0.3% point, right? So that means even though Singapore may not be affected directly, but if there's an overall very poor trade environment, lower business activities, smaller trade amount being done, so that will affect Singapore, even though Singapore may not be affected directly. All right, so that is the base case here. So we hope that this base case can stay together with this morning sharing. Our base case can stay, and we have a moderate kind of growth for China. Kun Hao mentioned this morning, yes indeed, we are calling for about 4.3% under this for China growth this year, from about 5%, 4.9% from 2024. So this is something not so bad like what Prof. Koh and also Prof. Chan mentioned this morning. So it's decent. Nothing fantastic. We should not think about, it's less, in the past it's 8%. So China is no longer in that stage. So something decent, I think that should be good for us as well, for ASEAN, for Singapore. Okay, so what happens here under this base case, we think about interest rate. The data from US have been very strong, particularly last Friday's non-farm payroll report, surprisingly strong from the end. So as a result, we are calling for maybe smaller amount or fewer interest rate cuts from the US Federal Reserve after cutting interest rates 4 times, 100 basis points last year. So this year, 2025, we're only calling for about 25 basis point cut, only 1 time for the US Federal Reserve by middle of the year. So you think about interest rate, later our rate specialist strategist, Victor, will walk you through about what's the implication for the short-term rates and also for the long-term rates as well as a result of these more conservative stance from the US Federal Reserve from the US Central Bank. All right, so that is under our base case scenario. Let's look at China. We talk a lot about China. Let's look at China. What is the outcome or expectation for this year? We are seeing China being stabilizing. Right, I think the deterioration, all those property market drop, I think more or less, is bottoming out. But I think more government actions were likely to be needed, and more is likely to come from the government, whether it's fiscal support or from the central bank in terms of its policy. So we should expect more of these next year. This morning, I think Prof. Chan already talked about, for example, next year, this year maybe they want to see, China may want to see what US policy might be before anything more substantial. Okay, let's take a look at what happened so far in September. The amount of stimulus that was provided by China, is estimated around 10 trillion renminbi, right? 10 trillion renminbi. Sounds very big, because if you think back, 2008, on your right-hand side, 2008, the government stimulus only amounted to about 4 trillion, right? 4 trillion, wow, sounds very big, 10 trillion this time. However, if you scale against the size of the economy of China has grown from 2008 to 2023 is about 4 times the size larger, right? 4 times the size larger, but your stimulus is only about 1.5 times, about 2 times or 2.5 times bigger, right? So that is where the gap is. So if you scale against GDP, in 2008, when the global financial crisis came, the Chinese government pumped in all the stimulus, it's about 12.5% GDP, right? 12.5% GDP. Today, or last year rather, last year it was only about 8% of GDP. So the size, the scale has changed dramatically. So is it enough? In this case here, I think it's enough to stabilize the environment, to prevent further deterioration. But is it going to give much lift to it? I think we have to see more later. I think more will likely to come later. So you can take a look at China's size of the GDP. So there will be some downside risk to our outlook, right? 4.3% later. I'll show you, Kun Hao already mentioned about 4.3% growth this year. What are downside risks? I think the real estate market is about 25% of GDP. I think it's still under a lot of pressure. There are some signs of improvement, right? The prices have stabilized. The prices have stopped dropping and still continue to drop, but the declines have narrowed, right? Become smaller. So that's the good news from China's property market. And then the trade war, trade tensions between the US and China. I think there's something to watch. Again, this morning, Fred mentioned about China's trade surplus is now close to about, last year was about 1 trillion, right? Close to 1 trillion. So that is obviously going to be a target of a tariff from the US, right? So that is something that we need to watch. Anything that happens to the two big countries, I think will affect Singapore as well, because we are such, and also ASEAN is so open. There's some upside risks that we should think about also, not too pessimistic, but there's some upside risks as well. The fiscal spending may be more coming into the system. There may be monetary policy stimulus as well. All right. So that's where it is, 4.3% for our forecast for China this year. Last year was about 4.9%. Again, you will see that all these volatility in terms of its growth, unlike those years where it's steady at about 10% for some years, right? Every year, 10%. So that is not possible for China at this stage already. All right, so that is what we are seeing. Our forecast is not overly pessimistic. I think there's something to look forward to. Okay? All right, so that is monetary policy. What should we expect? I think maybe for PBOC, there's a central bank, China's central bank. There may be some potentially cuts in releasing more liquidity to the system through this thing called triple R. There may be more of this coming. One is already overdue, supposed to happen last year. I think it will happen sometime early this year, triple R. And also we have these things to think about, this China impact on ASEAN as well. I think that's something to also to watch out, because China has become ASEAN's biggest trade partner. So that is, anything bad happens to them, I think it will affect us too. All right, so that is something to think about for China. Let's focus our attention on ASEAN, right? All these trade tensions and everything, and this morning Prof. Chan mentioned, this is, it's a place to be in ASEAN, right? It's a force for peace, right? So that's very important, because businesses thrive on certainty, which is your environment, right? Your environment is very important. If it's a peaceful environment, you can do a lot more things, and you can also expand your business, right, in this region, and that is something I think we should, keep in mind. I think the prospects are still positive. Now, ASEAN is very dependent on trade. Take a look at our trade cycle right now. It's actually in our favor. The trade cycle here is your import and export in all these 6 ASEAN countries we put together. And look at the upturn that we are seeing right now. It is on the way up, and there's still some months to go. On average,
if you calculate the average over the last 2 cycles, it's about 30 months, right? That means 2.5 years or so. Right now, we only use about, the up cycle is only about 6 months or so, right? So we have another 1 or 2 more years to go if the past cycles, right? If the past cycles are indicative of future performance, right? So there's still very good, I think the environment is still positive for Southeast Asia in terms of our trade activities. So there's something that we can look forward to, right? So that is import, export on the uptrend. So it's in our favor. And also in terms of investment, right? I have shown this chart many times to people, just to our clients and friends. ASEAN is the world's second largest destination for foreign direct investment. What is this foreign direct investment? The FDI. The FDI meaning companies setting up business in a country, not buying properties or investing in stock markets, but setting up factories, warehouses, logistics, and all those other business-related business-related activities is through this channel called FDI. Take a look at the 2023 number. We don't have the 2024 yet. 2023 numbers, ASEAN is the world's second largest destination after US. Now, businesses come to a place to make money, right? If this place is safe, I can have opportunities to expand, to sell more, to do more, I will come to this place. The policy, government policy is conducive, friendly, and ASEAN is the representative of that. And this is not just for 1 year. If you look through the history as well, over the past few years, we have always been at the top. ASEAN, the 10 countries here, particularly the 6 countries in Southeast Asia, the 6 major ones. Thailand, Malaysia, Singapore, Vietnam, and Philippines, right? Indonesia. So the top 6 countries particularly. So we are already well ahead of everybody. So when you have this kind of momentum, winners will beget winners, right? So that is in our favor. So it has been happening, and of course, in the audience here, our head of FDI, Sam, is right here at the table here, and he is looking at this and supporting companies investing in this region and to help our companies coming here to get more business, right, to make money. And this is what is happening here. And if you look at, on the right-hand side, the breakdown of different countries, Singapore is the number 1 because you are a financial center, and it has always been the case. You look back history, bulk of the money will come here. But at the same time, you look at Indonesia, Vietnam, these are the main attractions for foreign businesses to set up shops in those countries. Why? For example, Indonesia, commodities, and Vietnam, because of the processing as a result of supply chain shifts and other factors that allow countries like Vietnam and also Indonesia, Malaysia, Philippines, and Indonesia to benefit, and Thailand to benefit. All right, so in terms of outlook for next year, this year, 2025, I think growth is going to be is still going to be positive for ASEAN. In the middle here, we are looking at ASEAN this year roughly around 5%, similar to last year. A bit of unevenness. Thailand doesn't fare too well, but Vietnam will be the one that is contributing much of ASEAN growth, and Vietnam has been very strong performance, has seen very strong performance in 2024, and then this year, likely about 7%, not so much of not quite the same as what China has experienced, but it's very close. So this is some place where business opportunities you may see business opportunities as well in these countries. Others, China, 4.3%, a bit slower compared to Southeast Asia. So again, the prospects are still positive, very positive for Southeast Asia this year. And UOB is a bank for ASEAN, and that is where I think we can help our clients, to support our clients in the activities, particularly in Southeast Asia. All right, so that is, I think, the picture I want to show you to bother you so much. But the next item is that after hearing all these fundamentals and also the risks and uncertainty ahead, I will pass the time to our exchange rate FX specialist, Peter, to walk you through about the outlook for exchange rates, particularly dollar, and also, of course, your next holiday destinations where you should get your your currency and at what rate. All right, Peter.
Thank you.
Thank you.
Thank you, everyone. Thanks for joining us again this year. I see a lot of familiar faces, and thank you for entrusting us again, and wishing you a happy new year in advance. So I think the key message I want to send very upfront to everyone is Donald Trump 2.0, he's the tariff man. He will make US dollar great again this time around. So during the first term, the dollar strengthened. This time around, the second term, it's important to take note that his expected policy is going to strengthen the dollar further. So I'd like to set the stage. Since November, after he won the elections, the US dollar index has rose from 104 to currently 110 this morning, about 6% in the span of 2 months. This is easily one of the fastest pace of strength in the US dollar for the last couple of years. So definitely market is buying to the idea that the dollar strength will come back in a big way. So we have heard about that, we have probably read about that. Why is Trump causing the dollar to be strong? I think this is all because of the tariff. The tariff will cause inflation to go up. The Fed will slow down rate cuts. And because of that, the dollar will strengthen. And of course, maybe the tariff will trigger another round of risk aversion like what we saw in 2018. And when that happens, typically the money will flow out of emerging economies and back to the safety of the dollar. And lastly, of course, when dollar rates goes up because the Fed is not cutting as much, typically the dollar will also follow. But is it so clear-cut a story where everything is going to be so hunky-dory about the dollar? Let's also try to balance up potential factors that may cause the dollar to waver a little bit. And I'd like to point out this, that what if the trade war 2.0 triggers a global slowdown? And when that happens, typically the second order effect will see US growth getting hit back. And when that happens, if they enter a recession, the Fed will cut interest rate fairly aggressive. When that happens, you will see that the dollar will weaken. But I think at this point in time, it's a bit premature to look at this backdrop happening. Probably we'll just have to evaluate as it goes on. And the longer term factors, these are all longer term discussion topics that we always hear about. US diversification, moving out of the US dollar. Everyone is so scared about the US dollar, looking at how the US has weaponized sanctions against Russia just a couple of years back. So, but these are all longer term play that may happen. We don't know when it will happen, but it could happen. And of course, there's an ongoing debate that what if the market grows uncomfortable with holding on US debt, and when that happens, there's some loss of confidence in the US dollar, and that could cause the dollar to weaken. But as it is right now, it is overwhelming in favor of dollar if you look at the near-term factors. So I'd like to use this chart to give you a context why investors are buying the dollar right now. If you just focus on the red line tells you that US dollar commands a 2% premium against all other G10 currency, meaning that if investors just buy dollar today and hold dollar, it's easily 2% better than any G10 major currency like the euro, sterling, yen, Aussie, if you average it out. So that's the reason why the blue line, which is the dollar index, is following the red line, which is the interest rates. Yeah. And what's our prediction? I mean, I only have one prediction, which is where is the dollar going? So my best prediction is that the dollar will strengthen a little bit more. I think the runway is still there. Why am I saying that? I'm quite confident to say that the dollar will strengthen a little bit more because currently we are about 110 in the dollar index. The last high, the very significant level we have to take note of is 115, sometime in late 2022. But let's remember that that was during the rate hike cycle where the dollar is very strong. So I think that from now to 115, there's certainly the runway that's shaping up. That's the reason why we are seeing a little bit of strength to the middle part of this year before pulling back. So this is dollar against major currency like the euro, the sterling pound, the yen, the Aussie, and the Kiwi. And moving into the euro, I think to some people they see it as a crisis. Euro is definitely moving towards 1, which is a parity level. People associate euro at parity to the dollar as a crisis level because in the formation of the euro in the last 25 years, euro only sustained below parity for a very short period of time in the last 25 years or so. So anything below is typically crisis. And I see this as an opportunity because when it dips below parity, maybe in the first half of this year, this could be an opportunity for clients who needs for euro to accumulate at these levels because it should rebound again. For sterling pound, it has always been the currency that has not gone a lot of places in the last couple of years. We know that it's cheap. Against the Sing, we know that it's cheap. Against the dollar, it's also cheap, but it stayed cheap in the last couple of years. As a result of that, there is not enough positive factors to move it up a lot more, but at the same time, the downside risk is quite low to begin with. As a result, we have seen that sterling pound is the best performing currency last year. Let's give some credit to sterling pound because it has only dropped about 1% against the dollar last year, where most other G10 currencies fell 5 to 12%. Yeah, so it is cheap to begin with. I think we still see opportunity for sterling pound to move up gradually over time, and because I think one of the more important level is reason for that is because the terminal rate, the terminal interest rate between UK and US is expected to be about the same in the next couple of years. So the US do not have that strong advantage in terms of interest rate compared to the UK. That's the reason why UK pound is hovering around here, at least in the first half before rebounding. Yen will be the interesting currency yet again. I mean, I come in, year out, I talk about the yen, everyone is exciting. I think you probably came back from Japan many times and you still find that, wow, it's still a bargain. And the good news is, it will still be a bargain for a while longer. So if you missed out on winter, you can go in spring. Yeah, my second prediction is, in the second half of the year, the yen should recover. And it's back to a few reasons. First is monetary policy divergence. Japan has high interest rate 2 times in the last 1 year. The US Fed has cut interest rate by 1% in the last 1 year. Yeah? So going forward, Japan more likely to still continue high interest rate. US still cutting, although slower. So there's the big gap in terms of monetary policy actions that should drive yen recovery in the second half. Another story that could emerge in the second half is, what if the trade war goes very messy? And when that happens, typically there will be a safe haven story again. Then where people will start, hey, I haven't bought into the yen for a few years and it's now so cheap, why not buy the yen? I can see that story evolve just in case the trade war goes a bit messier. So these are the 2 reasons why I'm a little bit more confident to say that I'll put my stake and say, yes, the yen will recover in the second half. So first half could be your action timing. Moving on to the Asian currencies, I think this year with Trade War 2.0, I think no one is out there and saying that it's going to be hunky-dory for Asian FX. Yeah, I think it's all on a defensive positioning right now. And I think we are blessed in a way that we have the template of Trade War 1.0 to at least see what's the textbook case, what to expect of. And this is what happened in 2018, 2019. The dollar strengthened about 4 months before the first tariff and continued to strengthen after which for a while longer. So we are right now in the before stage. We expect the tariff to come in maybe as early as second quarter of this year. So we are still in the before stage. What I'm trying to say is that Asian currencies will continue. If this story continues to hold true, Asian currencies will continue to depreciate well into the most part of this year. And the USCNY is right now, this is the last trade war. We started the last trade war at about 6.3. The CNY is quite strong. Right now, unfortunately, the CNY is at a very weak number, 7.3 thereabouts. Yeah? So what I can put up as a third prediction is that I'm quite sure that this line is going higher. The question is how much higher? There's simply the lack of positive factors that could drive this line lower. That means positive China story. It's a matter of how much negative story is being priced in the RMB. So our best guess is that 765 by the third quarter of this year before pulling back a little bit. Yeah, but bear in mind, this is the base case scenario where we're looking at about 25% tariff. If you ask any analyst out there, what if Donald Trump goes ballistic and slaps 60% on day one? I will say that this, with a high degree of confidence, is going to go for 8. Yeah, so this is the number that people are putting in their minds, right? At least from analyst standpoint. Yeah. What about dollar Sing? I think we are in a good area. Sing is always perceived as a safe haven currency. And on the backdrop that last year we got a strong GDP performance. And looking at the last trade war, dollar Sing was quite stable. So I think right now, with some confidence, I think that the dollar Sing could still continue to go up a little bit. But in our base case, we are capping it at 140. But of course, caveat, base case is 140. Pessimist case is above 140. If dollar CNY goes 8, I don't think this will be whole at 140. Yeah. So, but there is a safe haven nature of Sing dollars that people will bear that in mind. And when that happens, the Sing dollar will be a little bit more stable. The last I have for you is possibly another opportunity. This is the SGD near chart. This is the performance of Sing dollar against a wide basket of currency. And as you can see over the last couple of years, in fact, since the formation of this basket, it has always been going up. It's a matter of what kind of pace. Thankfully, recently, we have a little bit of pullback, still within the parameters that MAS has specified. So what I'm trying to say over here is that typically, if the MAS continue to maintain a positive appreciation pace for the Sing dollar effective exchange rate, what this means is that typically every dips could be an opportunity to buy Sing against the crosses. So I give you an example just to round this up this section. Sing against the CNY. CNY is a clear target for Donald Trump, right? So in a trade war scenario, CNY should drop against most currency. Recently, the Sing CNY has pulled back from 545 to about 535 right now. So if the trade war evolves like what we think, we should see that the CNY should weaken back again against the Sing. That should go back up. So this could be, I can imagine that this could be a good area in time to start to look to also be positive about the Sing CNY. So with this, we'll end my section. Thank you for your time, and I'll pass on to Victor for his interest rates outlook. Thank you.
Thanks. Thanks, Peter. Good morning, everyone. And so we've heard Peter make his case for stronger US dollar, at least for the next couple of months. And before that, Teck Kin has taken you through the macroeconomic backdrop, as well as a couple of themes that we are looking at closely. So for my section, we'll round off the sharing with interest rates, what we think of monetary policy broadly speaking, as well as the impact and implications for the wider use space, like in the bond markets. So specifically, well, maybe not specifically yet. In a nutshell, we look at monetary policy, broadly speaking, as having enough legs to continue into 2025. So what I mean is that we've seen the Bank of Japan hike rates in 2024 last year. We'll expect another hike from the Bank of Japan this year. But for the vast majority of the rest of the central banks, it's a case of them easing last year and carrying on easing into 2025. Now, specifically with the US, our view is that we should see the Federal Reserve cut interest rates by 25 basis points, backloaded, so in the second half of this year. And with a contingent, another two rate cuts, perhaps only materializing in 2026. This is not a unique view. It's a fairly consistent view across all the analysts that rate easing should continue into 2025. Notably here as well, I want to point out that no one has really factored in the scenario of rate cuts, at least for this year. Right? So that's an important case to make because, one, you could look at it as because bond yields have been making the headlines recently, And if we were to start bringing in this scenario of rate hikes in 2025, then that would clearly be a big shift, and we would see 10-year treasuries, for example, durably and sustainably above the 5% mark. But as of this moment, no one is really picking the rate hike scenario or factoring the rate hike scenario. It's a bit early, and we tend to agree with that. So where US rates go, so goes the Sing rates. But we have to nuance it with our MAS policy view as well. So our MAS policy view is that we think that the MAS has room to ease monetary policy as well. So why is that important? Because that colors our view that our currency performance ought to travel along the weaker side of the trade basket. So why is a weaker Sing trade-weighted basket important for rates? Because historically speaking, when our currency is on the weaker side of the trade basket, then the transmission or the sensitivity to each US rate change becomes lesser. So this is our view on the MAS monetary policy. Historically speaking, less sensitivity in terms of the US rates transmission to our domestic rate space. We think that would continue to hold. And if we have if we look back on hindsight, I think this should still be the case. So yes, we have US yields coming down, but maybe less so for the Sing rates. So in terms of the big picture, at least in our coverage universe, right? Developed markets, as I mentioned earlier, is likely to see rate cuts continuing into 2025. Led primarily by the Antipodeans, so your RBA and your RBNZ, where they have more room. We see them having more room to ease their cut interest rates. The rest of the developed market central banks outside of the US Federal Reserve, we expect them between 3 to 4 rate cuts. We could get that in this year. Over in EM Asia space, the picture is slightly different. We are more circumspect on the amount of rate cuts that could actually be delivered. And one of the big reasons is, and it will come as no surprise because Peter has already mentioned it, is the currency performance. So with the strong dollar story, Asian central banks are well cognizant that where their currency is currently holding. And they'll be very, very reticent in terms of adding volatility by cutting interest rates too much. So that's why we have lesser rate cuts coming out from the Asian central bank space. So should be quite simple, right? Like, it's monetary policy easing, so yields broadly should be coming down. However, that's not the case. So you can, what we have experienced, at least measured since the US Federal Reserve cut rates, is that as they brought rates, the Federal Reserve rate lower, the 10-year US Treasury bond yields has actually gone higher instead. Hence, the conundrum, which is a very hot topic that's currently being discussed in the financial market news. So this choice of the word conundrum is also a very deliberate choice because 20 years ago, then US Fed Chair Greenspan also mentioned his conundrum. But it was a mirror image 20 years ago. So 20 years ago, Fed Chair Greenspan was hiking rates, but bond yields were actually heading lower instead. Ultimately, in the end, it did resolve higher towards the later part of its 2005 rate hike cycle. So whether we get the same resolution this time around, where yields will finally be brought lower and by US Fed rate cuts, remains to be seen. But at least for now, it poses a conundrum in the markets. So enough with the history lesson. So the question then is, why have we gotten this way? What has been driving the conundrum? First and foremost, we look at monetary policy expectations. So monetary policy expectations has taken a big shift as of the most recent quarter. So what we have seen amongst FOMC members is a big flip towards concerns about inflation. So inflation concerns took a big spike amongst FOMC policy members. They are also a bit more positive on the growth risk. So they see a bit more upside potential to growth outcomes. And it is important because if you think back to 2021, that was just before the rate hike cycle. Policymakers there also had a big shift in terms of their focus towards inflation. So the concern here really is inflation concern turning into inflation action, at least based by the the FOMC policy members. So this is something to watch out for. Again, we don't think the conditions are quite in play yet for rate hikes to be discussed, but something certainly bear watching. So the other reason for higher bond yields as well is term premiums or risk premiums, if you want to think about it in general sense. And here I want to sort of break it up into two parts, right? The multi-decade long-term trend is for term premiums, or has been for term premiums to head lower. But amidst this multi-decade long-term lower term premium trend, you have seen years, right, multi-years, where cyclically term premiums can go higher. And we are currently undergoing one of these cyclical upturn in term premiums. And why? Why is term premiums marking higher more recently? Well, because of the uncertainty, primarily from the fiscal policy front. So there's a huge amount of uncertainty there, added to the fact that the new incoming Trump administration is proposing for pro-cyclical policies. Given what we know about the debt situation in the US, that will place further pressure on the debt outlook as well. So all reasons combine to drive term premiums higher, at least from a cyclical basis. But if the long-term trends are still in play, then ultimately in the end, we may have a mean reversion event, and that could at least make it a bit more of a positive outlook for the bond market space. But for now, yes, cyclical upturn, so it's a bit challenging in terms of if you were a bond investor. So if I was to sum up, right, we have 2025 largely as a continuation year. We expect monetary policy easing to continue. Hence, the path of least resistance is really for yield curves to start heading steeper still. For the Sing rates part, with MAS expected to ease and our Sing dollar, at least on the measured on a trade-weighted basis, likely to become weaker, we expect less of any US rate declines to actually transmit over into the Sing space. So that's what I'll leave you with. But before we end our segment, I want to bring back Teck Kin to share some final remarks as well as any call to action.
Thanks, Victor, for the sharing. Thank you. Thank you. All right, so you have heard the sharing from three of us. I just want to summarize quickly for you some key takeaways for you. From the first section, I think we should not dismiss possibility of a rebound in China. That means don't write off China yet, right? So ASEAN is still the place with the opportunities. Outlook is still positive for ASEAN. So in terms of businesses, I think we can think about it more deeply and also more deliberately about your expansion, your business expansion, diversification of the trade in ASEAN. And Peter shared about the FX outlook. One of the key takeaways will be that it's still not too late to hedge your dollar, right? Because we're still expecting the dollar to go higher. And plus, of course, on the Japanese yen, there's still some time to catch, right? If you miss winter, make sure that you're able to catch a spring, because after that, the Japanese yen could strengthen, right? So that's on the FX part. And Vic also shared about interest rates. Now, for those of you who operate in most of the economies, just now on the chart, most of the markets, you will see that the interest rate likely to trend lower, right? So that is the environment that you need to also, I mean, you can take comfort that interest rates might be trending lower, but the extent of a lower may be subject to, I think, currency risk as well, except for Japanese yen, right? Because in Japan, we are still expecting the BOJ to hike interest rate. So hence, the currency part also we need to watch. So the key word here is, of course, work with our team work with our colleagues here within the bank to help you hedge your positions, to get solutions for your problems. We can provide solutions for your problems. All right, so thank you so much for your attention. I'd like to wish a Happy New Year to you and also an early 恭喜发财 to everyone here in the room. All right, thank you so much. I'll pass the time back to Charmaine. Thank you.
Thank you very much. Thank you.
Thank you,
Thank you,
Charmaine.
gentlemen. One more time for all three gentlemen for sharing the insights. Appreciate it. Now, ladies and gentlemen, for the final